Sainsbury's posted first-quarter total retail sales of £9.15 billion on 30 June, up 2.7% on the prior year, and shares rose 2.4%. The grocery division was the engine. Sales grew 3.6% as the chain matched prices with Aldi on hundreds of products, and Nectar loyalty discounts pulled more shoppers into larger weekly shops. But the headline figure conceals a structural break inside the same business. Argos, the general merchandise arm, saw revenue fall 0.5%, even as the volume of products actually sold rose 2.2%. The bottleneck is not demand, it is price. Consumers are buying more items while spending less per transaction, and that spread is now wide enough to push revenue into negative territory despite a physical volume recovery. That is the tension the 2.4% share rise did not fully reckon with. The grocery beat is real, and so is the Argos drag. And the question of which force governs the second half is the one the update did not answer. The Strait of Hormuz blockade raised energy and freight costs across the supply chain, and its pass-through was never going to be uniform. Food, inelastic, replenished weekly, absorbed the pressure differently from electronics and furniture, where consumers have a genuine option to defer or trade down. Chief Executive Simon Roberts said inflation is coming through in the food supply chain, but running below the Food and Drink Federation's initial 9% forecast for December. Shop price inflation held at 1.2% year-on-year in June, the British Retail Consortium confirmed on the same day as the update, a reading that suggests the worst of the grocery price spike has been contained, at least for now. But inside Argos, the transmission mechanism worked in reverse. Volumes of large televisions, fans, toys, and paddling pools rose during the May heatwave and World Cup fixtures, meaning physical demand held up. What shifted was the average selling price. Consumers systematically chose lower-priced products within categories, and promotional intensity rose as the market became more subdued and more promotional, in Roberts' own words. The result is that Sainsbury's non-food division is simultaneously winning footfall and losing revenue per visit, a combination that conventional market share metrics do not capture. The standard read on Sainsbury's entering this quarter was straightforward: grocery market share gains, combined with a premium range growing 15%, taste the difference, would deliver operating leverage that offsets employment cost increases. Hargreaves Lansdowne analyst Aaron Chikri framed it precisely: top-line growth plus efficiency should keep underlying retail operating profit above £1 billion. That logic holds if Argos and general merchandise return to revenue growth alongside their volume recovery. The buried assumption is that average selling price erosion is cyclical, a function of consumer caution caused by Middle East uncertainty and therefore self-correcting once confidence returns. But the data from the quarter challenges that assumption. General merchandise sales fell 6.3%, clothing declined 2.1%, and Argos revenue fell 0.5%, and all three moved down while their respective volumes moved up or held. Price is not recovering with volume. The consumer is trading down within categories rather than simply deferring, which is a different dynamic. Deferral resolves with confidence, but within category trading down resolves only when the price gap between entry and premium products narrows, or when household disposable income recovers materially. The verification variable is therefore not the next quarterly grocery read, but the Argos average selling price in the second quarter, a figure that discriminates between cyclical caution and structural trade down.
The counter-evidence to the recovery case is already in the pool. Roberts himself called the non-food market more subdued and more promotional, and noted Argos furniture sales were among the weakest performers in the quarter. That is not an invented risk. It is the CEO's own characterization of the margin environment his non-food business is operating in. A holder's posture. If Argos' average selling price stabilizes or recovers in the second quarter, as heatwave and World Cup demand converts into the back-to-school and autumn electronics cycle, the non-food drag was cyclical, and the grocery momentum thesis survives intact. If instead the Argos revenue gap to volume widens further in Q2, volume up again but revenue flat or declining, the trading down behavior is structural, and the grocery strength alone cannot compensate for a division that generates revenue per unit below replacement. A watcher's entry trigger is more specific: the H1 results expected in September 2026, and within that, whether Argos revenue growth crossed above zero in the July to September period. A September Argos revenue read that remains negative while volumes stay positive is the condition that makes today's 2.4% share rise a trap. The market re-rated on the grocery beat without pricing in the structural drag. A September read where Argos revenue turns positive confirms the cyclical interpretation, and the grocery plus recovery combination justifies re-entry ahead of what would be a materially better H2. The single metric to watch before acting is the Argos revenue versus volume spread in H1, not the grocery headline, which is already visible. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.